Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive right in, take a look, see what's going on today. If you want to follow me, it's at Fair Finance. And if you want to join our community, finding-value.com, I dive deeper into all these topics, looking for investment opportunities and sharing them with everyone in the community. And you can see how to sign up there in the corner. All right, scrolling down, we've got. I was just scrolling through Twitter here and I saw this, so let's share it real quick. It says, while retirement typically occurs after completing a career and saving and investing for it, a new trend is emerging among Gen Z career professionals called micro retirements. Micro retirements involve taking a 1 or 2 week break from work every 12 to 18 months. Gen Z is using micro retirements to avoid burnout, find greater fulfillment in their work, and enhance their overall well being. However, it's not just Gen Z. Um, I don't know what that really means. I mean, isn't that just a normal vacation? Why are we labeling it something different? A 1 or 2 week break, that's pretty much what everyone does. So I'm not sure that qualifies for a quote micro retirement. And furthermore, anything that you put micro in front of probably isn't a good thing. Micro meaning really small or short. So yeah, I think that's just a normal vacation, but I don't know what's going on these days. Talking about platinum versus gold and silver, I've got a ratio chart here of these. Um, just looking at the progression of the ratio, we're coming from, again, a ludicrously low level where platinum has basically sold off against gold for a very long market condition. This cycle, if we were to look at cycles back in the early 1998-99 timeframe, we had a squeeze into the corner and a breakout. And from 98-99 to 2008 was a commodity bull market. During that commodity bull market, platinum became expensive against gold. And it would have been a good investment at the beginning of that commodity bull market, where the ratio was cheap, to invest in it at a 1-to-1 relationship, where it went all the way to 2.3, 2.4 ratio. The end of that bull market was 2008 for most commodities. We had a very big sell off where gold outperformed the entire way till 2025. This past year, the ratio has bottomed, and now platinum is starting to work its way on up, at least from this downtrend line. And hopefully, we can start to break the upper trend line here, going up into an uptrend. There's a twofold thing here. One is platinum's the better performer, so platinum would be a preferred investment. That's number one. And number two, that could also signal that we could see a rotation into commodity stocks, and the commodity bull market uh, has started if we continue to see platinum outperform gold. So, twofold thing there. Another thing that I've noticed is that platinum is also squeezing up against silver and has recently broken out against silver. So we could see platinum outperform both gold and silver. And coming from this ratio, I've heard a lot of people talk about silver being the most undervalued asset on the planet. And I would say platinum could be considered the most undervalued asset on the planet given where it is here. And if you scroll in and zoom in on that right hand side, you can see we've broken out of that downtrend. The first breakout was this sharper downtrend here. Now we're starting to break a little bit more meaningful trend lines to the upside. And then obviously we're going to have horizontal resistance lines that we're going to have to break. And this is just the beginning. It doesn't mean that I know the path or that it's going to go straight up. I mean, it could, but it'll work its way on up, I think. against maybe perhaps both of these metals. I also think silver has a great setup from a charting perspective. So these things could race each other. It could be a pretty good race, and being involved in I think either one of these could be pretty fun with the 45-year cup and handle pattern breaking on silver and platinum breaking its 15-year pattern as well. Here's Anas. He says, who is surprised? India's coal consumption and manufacturing reached new highs amid demand. So India's coal consumption and manufacturing reached new highs. India's on the right track to attain a final coal production of 1.15 billion tons within the financial year of 25-26, consistent with a brand new report. The country's domestic coal production touched an all-time excessive of 147.6 million tons of full year 25, growing at a median annual rate of 10 in step with percent over the last 5 years, as in line with records compiled with the aid of Carriage rankings. So India is burning a whole bunch of coal, and they are trying to increase electricity, I'm guessing, from this coal. So yeah, they are burning it up and continue to increase production of it. Charlie Munger, he says, Warren talks about these discounted cash flows. I've never seen him do one. And Warren Buffett says, it is true. If you have to do it with pencil and paper, it's too close. It ought to just scream at you that you've got this huge margin of safety. The way that they invest is they use this huge margin of safety to find the value of the business or company. And then they want the price of that company to be far underneath the value of it. That's what margin of safety is. It's the difference between intrinsic value and the price. They don't do discounted cash flow models. I think what they do is they look at it and say, holy crap, this thing is cheap. That's when they buy. They don't buy it in any other case. What Warren has been doing is just stacking cash, perhaps putting it in treasury bills and then basically rolling over all those treasury bills as they come due until he finds this big margin of safety or this large difference between intrinsic value and the price of the stock. So he waits for it. He doesn't force it. He waits, and then he invests when that margin of safety is big. Real question. What happens? Okay, I want to go through this. This is exactly what Andrew and myself found with Bitcoin. So he says, the real question, what happens when all 21 million Bitcoins are mined? Right now, miners spend around 1.8 million kilowatt hours of energy to mine a single block. At 5 cents per kilowatt hour, that's roughly $92,000. For now, they earn 3.125 Bitcoin. At current prices, that's 337,500. The incentives work. But the supply is finite. At 21 million, Bitcoin stops emitting. Then miners rely on transaction fees. The problem is, fees make up only 7% of their income. That's about $23,000 per block. To cover just electricity, fees would need to quadruple. To cover hardware, risk, and profit, even more. Bull runs help, so do things like ordinals, but they boost fees temporarily, not forever. For fees to scale sustainably, Bitcoin needs constant global demand. It must become a settlement layer for the world, or introduce high-value transaction types we haven't seen yet. If it remains a static store of value, aka digital gold, the model breaks. If the incentives break, security weakens. And Bitcoin only works if it's secure. That's the part I can't stop thinking about. So he found out, maybe, or has read, kind of what we've known for, I don't know, 5 or 10, 5 years, 10 years? People may catch on to this. And if those incentives are not enough to keep the miners going, the transaction fees will become ludicrous. And we have speculated that if the Bitcoin price falls, that we could see the price be frozen forever at a certain price because the transaction fees become so ludicrous that nobody's going to want to transact at a certain price if that were to occur. We don't know exactly what it looks like in the future when the mining incentives of earning Bitcoins runs out and it all transfers to processing or transaction fees. But the majority of them aren't going to wait around and find out. They're going to sell, take profits, and hope everyone else for the best. But that's the problem that we see as well. Sam Gatling says short sellers are carrying their largest position in the gold miners since 2018. Do you think they'll regret it? So here's VanEck GDX. It's going highest level since 2012, basically breaking um, two highs, but the short interest keeps going up. Are they going to regret it? Are we going to turn lower? I'm not sure. I'm in the camp that I think we're going to go higher. So I'm going to keep my my holdings in maybe not GDX, but in a different ETF. I'm going to keep them on. There's no, I'm not scared or anything like that. But yeah, short interest is high, and maybe they get squeezed. Maybe they're right. No one ever knows the short-term kind of market movements. Longer term, I think we're going higher in gold and silver. Now, will the miners ETF follow it? It's a good question. I don't know. We could see gold go up, and we've seen miners in history go down. Sometimes they go up with gold. It depends on the market conditions. But I think that gold and silver will go way up, and I'm going to have exposure to the miners, irrespective of what short interest is. Tim says, I don't care what gurus say. Being wealthy solves 90% of your problems. Maybe. I don't know about 90%. I don't think it solves your most, it solves some problems. It may not solve a lot of the problems that people have. Um, when you think wealthy, being wealthy is a choice. So a lot of people choose to have a lot of problems because they choose not to be wealthy. And I know that seems kind of weird, but I would say the majority of people that I know choose not to be wealthy. What they do is they want to buy crap. They want to buy new cars. They want to buy houses. They want to buy crap. A lot of them, they borrow money to do it. In order to be wealthy, you have to choose to forego buying materialistic crap when you're young, investing it, and letting it compound for you. You don't want compounding to work against you by loaning money at 10, 5, 10% interest rates. So being wealthy does solve a lot of people's problems, maybe not all of them, but being wealthy is also a choice. And a lot of people choose not to be wealthy because it takes sacrifice, discipline, and hard work. So someone can say being wealthy solves 90% of your problems, but most people are the problem that they are not wealthy. It is the decisions that they make. And even if you were to educate them, it doesn't mean that they would make those decisions. There are plenty of people that attend schools, they know about compounding, and they still choose to buy crap, materialistic stuff, because that's what they want to do. It's an active choice. The Druck discusses why he believes in putting all your eggs in one basket and watching that basket very closely. Um, I'm not in that camp. I would disagree that a lot of people, if they were to do this, would not do very well. Now, if you're very good with the markets and you follow them very closely, what you'll see is there are times where the market misprices assets. And I think this is what he is talking about. And I know I didn't listen to this clip here, but when things get mispriced and you see it, you kind of want to go all in. If the mispricing is a good opportunity. If the risk reward is really, really, really good, um, I think that's what he means by putting all of his eggs in one basket. But you have to understand and you have to know the markets well enough to understand when that opportunity exists. So you're watching all of these different sectors. Maybe it's 30, 40 different things that you're watching. And then you see something through history become like it's a weird market condition and something becomes drastically mispriced. What he's saying is he wants to load up on that kind of opportunity that he sees. Hopefully, it's just a gigantic asymmetric trade where you lose very little if you're wrong and you win a whole bunch if you're right. And that's what I think he means by taking advantage and really going big in it. So it's him watching all these different things in the market. There's a weird market condition that comes into place. Something gets mispriced, and maybe it's like, as an example, maybe it's like a 2007 event where you're in '07. He wants to go long bonds, and he sees like the whole market deteriorating. So it's a good time to go really, really long in bonds because he sees the deterioration in the housing market and he thinks the market's going to crash. And that's what I think he means by kind of these events that you can see and the mispricing in the market. Freddie Krueger says, how are you doing relative to your age group, U.S. net worth? So this is the net worth by age group there. So the 25th percentile, kind of on the bottom end. I'm in this range here, so that'd be only 23,812. The 50th median is 134,382. The 75th percentile is 436,000. The 90th percentile is 1.18 million, and the top 1% is $7.8 million for someone my age, just to give an example. Um, was I surprised by this? No, not really. I would have thought that people around 40 and 44 they have around like 500,000 is kind of what I would think. And the 75th percentile was 436. So I mean I thought people maybe had a little bit more money, but that was about it when I saw it. Critical raw materials for the defense sector and the significant dependence on a few major suppliers. So this is it. Oh, it looks like it's real tough to read, but we'll skip that since it's really tough. But they do have some stuff in there. They've got aluminum, cobalt, gallium, germanium, graphite, lithium, manganese, platinum's in there for platinum group metals, REEs, which is rare earth elements or materials. They've got titanium and tungsten, is what I see there for critical raw materials. He says, Amin Nasser, CEO of Saudi Aramco, says the OPEC plus fields are depleting at 5.5% per year. OPEC pumped 41 million barrels per day in June. That puts her 1 year depletion at 2,250,000 barrels per day. I found it interesting that he made that admission, considering the secrecy surrounding OPEC plus oil production. So 5.5% per year, that's pretty big. And then given how much they're pumping, which is quite a bit, they're pumping quite a bit. Ian Castle says, everyone complains about the lack of analyst coverage in micro small cap, but those analysts have been replaced by thousands of blogs, Substacks, communities, X that do better work coverage than any of those analysts ever did. The game has changed. Yeah. Um, I don't know if I agree or disagree. I'm not really in the micro small cap area. I kind of like a little bit less risk than that size of company. But yeah, there's a lot of people out there doing their analysis of companies and they're sharing the analysis on all this stuff. It's a lot easier to gain access. Now, I don't know if these analysts or people doing these analysis are good or not, like if their analysis is that great or not. So what I see is a lot of people, they don't do their own analysis. They believe what they see, and then they make decisions based off the credibility of maybe the analyst, um, or the person, whoever's doing it. Peter Lynch says, if you can't find any companies that you think are attractive, put your money in the bank. Warren Buffett says, if there's nothing smart to do, cash is the default option. So some people are asking about cash. How much cash should I have? Well, if there's no opportunities, put it in cash. If there's opportunities, I would deploy it. Choose your fighters. Trump Ascent or Elon American Party. I don't know. But I thought this was funny. Lynn Alden responded with, neither will stop the train. I thought that was funny. Nothing stops this train. Art Berman says the thesis is that using natural gas as a bridge fuel is a trap because it reduces investments in renewables. He says the real trap is energy blindness. Renewables are a pipe dream that can't support civilization. Nice, getting a little bit of opinions going out there and riling it all up. Talking about the natural gas trap. 5 years, you can only hold one asset class. Which one is it? I voted for energy, oil, gas, coal, URA. I think that we have big problems in energy. Precious metals sector, that was the number one. I also think that's a very good sector. I was split between these two. If I could only hold one asset class for the rest of my life, I would probably choose precious metals. But over the next couple of years, I think energy is going to do real well. He said 5 years. I think that would probably be a pretty good bet. And I think precious metals could outperform energy. It's a possibility, but I think they're going to be pretty close. And I think there's a lot of good energy investments. The low point for share prices is when most people are expecting bad news, not after the bad news comes out, says John Templeton. I think that's where people get confused. When a stock bottoms, when the share price bottoms, it's when all the bad news has been priced in. It's not when the news comes out, it's when the news is recognized by everyone and the sentiment and bad news is all priced in. So that's when something bottoms. And you have to use charts to do it. You can't really use news flows. You can't use some of these gauges in the news to determine that. You need to see how people are positioning. And then it becomes who can get in at the bottom. It's people willing to kind of buy when that sentiment is really bad. But that's all I've got for today, guys. Thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. It's the coupon code in the corner there. And that's all I've got for today. So we'll catch you next time. This is Finding Value.